Hi, I'm Mike. I started this channel to share my passion for researching companies and investing. My investing style is really focused on long-term holds, looking at really disruptive and innovative companies. Let's get right to it. Today, I want to talk to you about Jumia Technologies, ticker symbol JMIA, and why, despite its 10x plus run off the lows, why I think it's still a great buy and a stock that you should be accumulating on any significant pullbacks. I really believe this could be one of those stocks that not only pays off in the short term, but that investors who hold for the long term will be rewarded. For those of you who don't know, Jumia is the leading e-commerce platform in Africa. There's comparisons made to Amazon, as their core business is actually quite similar. They operate in 11 different countries. They offer a marketplace primarily for third-party sellers. They offer logistics, so package delivery, as well as a payment platform, Jumia Pay, which is really disrupting and transforming a predominantly cash prepay society. I want to start with the Jumia stock, and it's had quite the roller coaster ride since going public in April of 2019. I think the IPO price was just over $14 a share, quickly shot up over the first 4 or 5 trading days to over $40 a share, and then had this quick decline until fall of 2019, where it kind of based around $5 or $6 a share. And then when the pandemic hit, it further dropped to like $3 a share, about 95% off the highs. And you can see it obviously recovered here, but I'll get into that later. So what happened? Why did it lose almost 95% of its value? Looking at the revenue here, you can see in 2019, it actually still increased from 2018. So in 2018, we're looking at about 148 million. That was up to 180 million. So about a 20% increase in 2019. So decent revenue growth, definitely not enough to warrant a 95% share decrease. Granted, they were still operating at a loss, but nothing surprising. So what happened? Well, shortly after going public, we knew this was going to be a volatile company, but literally within weeks of going public, Citron Research, Andrew Left, activist, short seller, came out with a really, really negative newsletter or hit piece or whatever you want to call it, basically saying not all IPOs are created equal. Jumia is a fraud and the equity is worthless. And I don't want to go into too many details, although this is important, but Citron actually went on to completely 180 and become quite positive on the stock. So I don't want to spend too much time talking about this piece, but really it claimed that Jumia inflated its active consumers and active merchant figures by 20 to 30% in their F1 filing, and 41% of orders were returned, not delivered, or canceled. Almost 30% of orders were canceled in 2018. So quite a negative piece, and definitely had a negative impact on the stock. And later in October of this year, Citron Research, Andrew Left, comes out and says he's changed his mind on Jumia and calls it the generational buy. Investors listen well. So complete 180. Andrew Left does acknowledge that in May of 2019, Citron noticed discrepancies in financials between investor presentations and SEC filings, and there was fraudulent orders, and recognized a company burdened with inefficiencies. And now he says everything has changed. He draws comparisons of Jumia to Mercado Libre, Alibaba, and C Limited. So those are e-commerce platforms, and they've all had explosive growth after seeing, some more challenging times early on in their days as a public company. They go on to say that the pandemic has accelerated a global shift in e-commerce, and Jumia has also benefited from this. There's been acceleration of e-commerce adoption by Nigerian consumers. Jumia has renewed focus on profitability, the rapid acceptance of fintech products in Nigeria, including Jumia Pay, the ability to use Jumia as a platform for ancillary products. They also go on to talk about the total addressable market in Africa, which is just absolutely massive. So total population, 1.3 billion, 523 million internet users, which, is actually surprising to me. Like it's obviously small as a proportion of the population, but that is a large population base that is connected. And it's the fastest growing continent in the world. And McKinsey estimates that Africa e-commerce will grow to a 75 billion market opportunity just by 2025. In Nigeria, over 40% of the population is under the age of 14. So they go on to say here that either these young Nigerians will be the first people on earth not to accept e-commerce, or the stock is going to 100. And I think I've seen Andrew Left quoted as saying that within 5 years he sees the stock reaching even $150. So that's still a 3x from current prices. So as I mentioned, Jumia operates in 11 countries in Africa, and those countries account for about 600 million of Africa's population, and has about 70% of Africa's internet users. So they are in the more developed areas of Africa, and they fine-tune that. I think at one point they were in at least 15 or maybe 16 countries, and some of them just weren't working out. So they're fine-tuning their business where they have the opportunities. Citron also goes on to talk about a survey that was done that revealed that 39% of consumers in Nigeria started purchasing groceries online, and 42% started purchasing food delivery online. And that's actually something recently that Jumia has moved into, is sort of these high margin, low cost goods. Also goes on to talk about Jumia's move towards profitability. So looking here at their latest Q3 that ended September 30th, 2020, you can see revenue actually declined on the quarter year over year, nearly 18%. And on the 9 months ending September 30th, just shy of 12%. So that's not great. And on the surface, I think analysts, had a bit of a negative view of that. But if you look closely here, it's really this first party revenue, which is down about 53% on the quarter and 47% year over year on the 9 months ending September 30th. So that was a strategic shift that Jumia said they were going to do. So they were going to focus more on third-party sellers, those high margin, low overhead products, and sort of reduce their first-party selling and get out a lot of the low margin electronics, etc. So they were really only going to only first-party products that were going to sell are ones where there's real gaps or a real need for the public, or that just made sense financially. And here they even state first-party revenues decreased by 53% in the third quarter of 2020 compared to the third quarter of 2019. This was in line with our strategy to undertake fewer sales on a first-party basis as we focus on running an asset-light marketplace model where third-party sellers offer consumers an expanding range of products and services. Another highlight of the quarter was Jumia Pay. Total payment volume was 48 million euros, a year-over-year increase of 50%, with more than doubling platform total payment volume penetration. So these are the number of people that are paying with Jumia Pay on the platform, which in 2019 was just 12.2% of gross merchandise value, so the total value of the product sold, versus 25.6% on the quarter year over year in gross merchandise value in the third quarter of 2020. So a pretty big increase in adoption of Jumia Pay. And we also saw adjusted EBITDA loss in the third quarter of 2020 decrease by 50% year over year as a result of those strategic shifts. So they are making steps to reach profitability, and really I could see them being there by towards the end of 2021 or early 2022 at the latest. So some really good stuff from Jumia, and good on Andrew Left for willing to change his mind on a company. I think that's something all us investors have to do, is look at companies that we own, we don't own, and be willing to change our mind if our thesis no longer holds. Back at the Jumia stock, after the Citron hit piece, shortly after going public, stock dropped from $40 a share all the way down to about 3 pandemic lows, and then was trading at about $8 a share when Citron came out with their positive piece on Jumia, changing their mind, and the stock immediately from October 2020 to the end of the year went up from about $8 a share to back up over 40, kind of sitting right around those those trading levels that it was shortly after the IPO, before the Citron hit piece. So it's still, even if you're thinking you might be late here, the stock has been up about 1,000% from the lows here, but it's still just a $4 billion market cap at these levels, at all-time highs, and it's still just off the levels it was about a year and a half ago. This company does remind me a lot of Sea Limited, the e-commerce company in Singapore. There is some differences in the business, but definitely a lot of similarities too. And this thing, after some early struggles in 2018 and early 2019, has just exploded. Again, up about 1,000%, in the last year and a half or so to current levels. I am a shareholder of Sea Limited. I did get in a little late on this one. And also Mercado Libre, the Latin America e-commerce marketplace. And this company, again, also had some early struggles, but up huge from, $100 a share up to now over, $1,600 a share here in early 2021. So just incredible. This one I've had on my watch list for a long time, never pulled the trigger, always felt like I missed it, and I just should have bought it. So it's one of those ones I just watched go straight up for, about a year and a half. So both Mercado Libre and Sea Limited have much larger market caps than Jumia. Like they're, granted they have higher revenues too, but they're sitting at about 80 billion to $100 billion market caps. So, I don't see any reason why Jumia couldn't get there eventually. As I mentioned, there's not a lot of analyst coverage or news on Jumia a lot of times, but recently I have seen Stephen Weiss, a frequent CNBC contributor, talk about Jumia on air. And he also did a recent interview with Benzinga where he talked quite positively about Jumia, how Jumia has a first mover advantage in Africa. He also made comparisons of Jumia Pay to Square and how Jumia can become the Square of Africa. And probably most importantly, why he's so bullish on it is that Jumia is a company building for profitability. Keep in mind that this is a speculative play and a lot can go wrong, especially in the environment they're operating in. But I do expect that with these strategic shifts that Jumia has made, that they're going to see significant increase in revenues and analysts are going to get behind this. A big question to ask yourself with a company like Jumia, I think, is where you think it's going to be in 10, 15, 20 years. And you look at it now with a market cap of 4 billion, it's going to be a volatile ride and, watching it day to day. But where do you think it could be in that kind of time frame? And I don't see why it couldn't be a $100+ billion company, if not much, much larger than that. That being said, I think there's a lot of upside in the short term. I see Jumia stock trading at close to or over $100 a share within the next year. I personally have been a shareholder of Jumia for over a year. Looking at my portfolio critically going into 2021, this is a company I actually want to be adding to my position on any reasonable pullbacks and be accumulating for the long term. Anyways, I really hope you enjoyed this video. Happy investing and see you next time.